Welcome to the Explainer. So let's talk about something most of us have, but maybe haven't really read, your fire insurance policy. It's more than just a piece of paper, right? It's supposed to be a promise. Today, we're going to crack open that promise and see what you're really covered for. So here's a question for you. Your policy, it's not just a simple IOU from the insurance company. Nope, it's a real deal legal contract, and it's built on a whole foundation of specific rules. And believe me, knowing these rules can be the difference between getting your claim paid or getting that dreaded denial letter. So to really get a handle on what you're covered for, we have to start with these 6 core principles. You can think of them as the invisible foundation of your policy. They're what makes everything tick when you actually need it. Okay, here they are, all 6 of them. This is the legal DNA of your policy. Now, while they're all super important, we're going to zero in on the big 3 that really affect you, the policyholder. We're talking utmost good faith, insurable interest, and the big one, indemnity. All right, first up, utmost good faith. This one's pretty simple, actually. Think of it as a pact of total 100% honesty. When you're applying for insurance, you've got to lay all your cards on the table. You have to disclose every single important detail that might influence their decision. Because, what you don't say can sometimes be even more important than what you do. Next, we've got insurable interest. This is actually a really cool legal concept. It's what stops an insurance policy from just being a gamble. It basically means you have to have a direct financial stake in the thing you're insuring. You've got to stand to lose money if something happens to it. It's why you can't, take out a fire policy on your neighbor's house and then just hope for the best. You've got to have some skin in the game. And now, for what might be the most important principle of all, indemnity. Listen up, because this is key. Insurance is meant to be a financial reset button. Its whole job is to put you back in the exact same financial spot you were in the moment before the loss. It is not a lottery ticket. And getting this concept is absolutely crucial because it helps you avoid a super common and really costly mistake. And that mistake, well, it ties directly back to that principle of indemnity, the whole idea that insurance is there to make you whole, not make you rich. This brings us straight to one of the biggest traps for policyholders, underinsurance. This is where a simple little miscalculation can end up having, devastating financial consequences. You see, buried deep in the fine print of most policies is this little thing called the Pro-Rata Average Condition. It's a mouthful, I know. But what it says is basically this. If you insure your property for less than what it's actually worth, you're telling the insurance company you're okay with being your own insurer for the rest. You're agreeing to share the risk. Let's make this real. Check out this scenario. Let's say your property is actually worth 40,000 rupees. But hey, you want to save a little on the premium, so you only insure it for 30,000. Then, disaster strikes. A fire causes 16,000 rupees worth of damage. Okay, so you've got $16,000 in damage, and your policy covers you up to 30,000, so you'd get the full 16,000 back to cover the repairs, right? Seems logical. Nope. Wrong. And this is where it gets painful. Because you only insured for 75% of the property's true value, the insurer is only on the hook for 75% of your loss. They do the math, and that leaves you with a check for 12,000 rupees and a 4,000 rupee hole in your pocket that you have to cover yourself. So why is this such a big deal? Because when you underinsure, you've basically, without even realizing it, signed up to be a co-insurer. You've become a partner with the insurance company in paying for any disaster that happens. All right, now that we've got the rules of the game down, let's get into the nitty-gritty. What does a standard policy actually promise to cover? What specific events, or as they call them, perils, are you actually protected against? So a standard policy covers direct damage from a whole range of these perils, and some of them are pretty surprising. Obviously, you've got fire and lightning, but it often includes things you might not even think about, like explosions, riots, big storms, and even damage from a car hitting your building, as long as it isn't your own car, of course. But, and this is a big but, what's not covered is often even more important. Every single policy has exclusions, and you really need to pay attention to them. Huge stuff like war is obviously out. So are consequential losses, like if your business can't operate while you rebuild, that lost income isn't covered. And look at this one. This is a big one. Certain electrical risks. This distinction trips a lot of people up, so let's break it down. Let's say you have some faulty wiring inside a wall. It overheats and starts a fire that burns down half your kitchen. The policy will pay to fix the kitchen. That's the fire damage.
but it will not pay to replace the original faulty wiring or the appliance that caused the whole mess in the first place. It's a subtle but super important difference.
So a standard policy is really just your base level protection. It's the starting point. But what if your risks are a little different? Well, the good news is you can almost always customize your policy with add-on covers to get more specific protection. And just look at this. There are a ton of options out there. For instance, if you live somewhere with a lot of earthquakes, you can add that on. If you run a business with cold storage, you can see there are special add-ons for spoilage if the power goes out. The whole idea is to plug the specific gaps in your standard coverage that could leave you totally exposed.
You really have to think about your specific situation. A standard policy almost always excludes earthquakes, but you can tack that coverage on. If you're a landlord and a fire forces your tenant out, a loss of rent add-on can save your income. Standard policies might cap debris removal costs at just 1% of the claim. You can buy more coverage for that. It's all about tailoring the policy to fit your actual, real-world risks. Okay, so we've gone through the principles, the perils, the pitfalls, everything. After all of that, what's the one single most important thing you need to walk away with? It really all boils down to this single sentence. Your fire policy covers material damage. That means direct physical damage to your stuff, and it only covers it when it's caused by one of the specific perils listed in the policy. It's not a catch-all financial safety net for anything bad that happens.
So here's your action plan. This is what you need to do. First, really get a handle on that principle of indemnity. Second, go check your policy value right now. Make sure the sum insured actually matches what your property is worth. Third, read the exclusions. I can't say this enough. They are just as important as the things that are covered. And finally, think about if you need any add-ons to cover your unique risks. So we'll leave you with this final thought. Your insurance policy is a promise, one you pay for every single month. But do you actually know what it's promising you? It is so worth your time to read and understand that promise now before you ever have to make a claim.